Billionaire Henry Ford once said it's a good thing most people don't know how banks work, or else there might be a big change. Lots of people don't know much about money, and that's why some people have a lot and others don't. You can't become rich unless you know how to handle money. Today, I'll tell you some secrets about banks that only rich people know. How do banks make money from you? And what's the best thing to do with your money so it doesn't end up making greedy bankers richer? Find out now. Subscribe to our finance channel if you want to get rich. Way back in the 7th century BC, the city of Babylon, which was doing really well, had its first bankers. These bankers lent out money and charged interest. That's also when the first banknotes appeared, and they were worth the same as gold. The word bank comes from the Italian word banco, which means table. At first, banks mainly exchanged big money into smaller amounts and did other cash-related stuff. But as economies grew, banks started offering more services. The first official private bank in the world is thought to be a group of private folks from Genoa who teamed up in the 12th century. They gave a big loan to the authorities of Genoa Republic for a war in 1148, and in return, the authorities let them collect some taxes until 1407. After that, the Bank of St. George was officially formed. Back then, people had mixed feelings about banks. Some thought they were reliable, while others saw bankers as greedy or tricky. Moneylenders were even denied church rights and normal burials. Even today, many folks still don't fully trust banks. And it's true, banks do keep some secrets. I'll tell you more about them now. Banks do not hold physical cash. Deposits are often seen as a reliable way to earn money without much effort. However, in many countries, this method is not effective because the interest you earn from a deposit does not keep up with inflation. For instance, in 2020, major banks in Switzerland offered interest rates on deposits ranging from 0.5% to 1.5%, but the inflation rate was between 1.5% and 2%. This means that inflation would consume any earnings from your deposits. Banks tend to set lower interest rates on deposits because high rates do not benefit them financially. Instead, they profit by lending out the money people deposit. They charge borrowers a higher interest rate than what they pay to depositors and make money from the difference. Furthermore, the government has an interest in these financial activities because they help regulate the economy. By controlling deposit and lending rates, the government can influence economic growth and stability. This control also means that not only the depositor, but also the government has some level of access to and control over the money in the deposits. Wealthy individuals, aware of these dynamics, often look for other ways to safeguard their wealth. Banks primarily exist to serve their own interests. They use deposited money to make more money through loans and other financial activities. Once you deposit money in a bank, it becomes an asset of the bank, and they use it as they see fit, often prioritizing their interests over those of their depositors. The relationship between the amount held in deposits and the amount the bank can lend, credit limit, is usually skewed in favor of the bank, reinforcing their dominant financial position. Banks often hesitate to lend money to people who seem poor. Bankers are typically some of the best-dressed professionals in the world, and they often, whether consciously or not, evaluate others based on their appearance. If a customer comes into a bank looking disheveled or poorly dressed, the bank may be reluctant to offer them a loan. The perception is that if someone appears as though they desperately need money, they might not be a reliable borrower, whereas those who look well off are seen as less risky and more likely to be approved for a loan. The main way a bank can go beyond appearances is if the person has an existing bank account. With access to an account, bank staff can verify the individual's financial status by looking at their actual balance and transaction history, rather than making assumptions based on clothing or grooming. However, in the absence of an account, bankers tend to make quick judgments based on how customers present themselves visually, which can significantly influence their decision to lend money. Bankers receive a yearly bonus based on the number of loans they issue. Not all bank employees get a yearly bonus, but those who are in charge of issuing loans, like managers, do. This bonus is tied to how many loans they grant. Naturally, they want to ensure the loans are safe and won't cause losses because everyone likes getting an extra payout at year's end. As the year progresses, the pressure to issue loans can increase, especially as it nears the end. Early in the year, there's less pressure, but towards the end, managers might worry about losing their bonuses if they haven't approved enough loans. They also don't want to be seen as not doing their job well. Rich people often use this to their advantage. They apply for loans at the end of the year, when managers might feel more pressure to approve applications to meet targets. They are likely to get approved because they can provide necessary collateral and are seen as credible by the bank. Banks profit from your account and reputation. Banks possess an extremely valuable asset, their customer databases. These databases contain detailed information about clients, which banks leverage to enhance their profits. They do this by tailoring and promoting new financial products directly to their existing customers. More troubling, however, is that some banks may engage in less ethical practices, such as selling these customer databases to other financial entities. These buyers might be companies that offer microloans or, in less scrupulous cases, even to groups that might use this information for scams. The integrity of such transactions largely depends on the ethical standards maintained by the bank staff. In addition to using customer data, banks also generate revenue through various fees associated with credit cards. One common method is by offering credit cards that confer certain statuses or perks, for which they charge annual or monthly fees. Another revenue stream comes from what's commonly referred to as a shadow tax. This isn't a direct fee charged to the cardholder, but rather a hidden cost that manifests in a different way. When a purchase is made with a credit card, the merchant is charged a fee by the bank for processing the transaction. To recoup this cost, merchants often increase the prices of their goods or services, effectively passing this tax onto the consumer. As a result, when you purchase items with a credit card, you end up paying more than the listed price without necessarily realizing that you are covering the transaction fee indirectly. This system allows banks to covertly profit from every credit card transaction, adding to their margins at the consumer's expense. More favorable conditions for the wealthy. Banks operate just like any other business, needing to generate profits to stay operational. They have shareholders to whom they must report and who expect returns on their investments. This financial pressure influences the bank's lending practices, often making them more inclined to lend to wealthier individuals rather than those with less financial stability. The reason behind this preference is based on risk assessment. Wealthy individuals generally have more assets and resources, such as businesses or property, which can serve as collateral or be sold to repay the loan if they default. This provides a safety net for the bank, reducing the risk associated with the loan. Furthermore, banks also consider their own financial security. In scenarios where the bank itself might face financial difficulties, having loans out to individuals who can provide quick repayment or substantial collateral can be a strategic advantage. Essentially, banks plan ahead for their own potential crises by securing loans with those who have the means to pay them back under less than ideal circumstances. For the average person, this underscores the importance of managing finances wisely and understanding the financial system's structure. Effective financial management can help individuals improve their creditworthiness and navigate these biases in banking practices. The information I shared today isn't meant to discourage you from using banks altogether. It's just important to consider different ways to handle your money. For instance, instead of just putting your money in a savings account, you might think about investing it or putting it into a business. Also, sometimes paying cash instead of using a credit card can save you from hidden fees, known as shadow taxes. Be smart and don't let the system trick you. Understanding these tips is crucial to building wealth.
That is all for today, and make sure to subscribe if you want to learn more. Withdrawal Investing Insights signing off. See you in the next video.